recorded. We'll get started with our last pitch. Today we have two groups with two buy recommendations and one sell recommendation with a watch list. As you know, this is something we added this year. We added the sell recommendation, but also every time it doesn't have to be a sell. It can be a watch list for stocks that are potentially that might be on our sell list eventually. And this really completes our portfolio management side of our Smith fund. And the last update about before we get started is that our Smith fund right now has actually crossed $950,000 fund value, which is really tremendous given what we have had in not just the past year, but also the past 10 years since our inception. So we're getting close to the $1 million milestone. And I have no doubt our students next year will help us achieve that goal. Without further ado, I will let our students take the floor. Please go ahead, Team 1.
All right. Hi, everyone, and thank you so much for joining us today for our last ASA pitch. My name is Anton Ashrafyan. I'll be joined by Timothy Henning, Tyler Schulman. Once again, we just want to thank you for all the time you've given us, for all the feedback, all the questions. It has been a wonderful journey. Now, moving on, we're going to be presenting PowerFleet. Let's move on to the most important part, why we should buy this company now. Well, as always, we're always looking for the companies that have not ran up just as much. So there's a lot of possible growth and market expansion for this company. There's also a very attractive operating model that Tim and Tyler are going to be covering shortly. Because of that, they're exposed to parts of the markets primarily through their possibility of adopting the IoT solutions in the industrial sector. Moving on to the actual investment. What I mean is what the company actually. So they have a single platform to be able to understand what is happening to all of your assets. Think industrial, so what's happening to your forklifts, what's happening to your workers, how long the machines are being used, how they're health, work, or safety. Now, logistics, any kind of transportation, refrigerator trucks, shipment containers, anything that is being transported from one place to another, as well as vehicles, so any kind of Avis, budget, any kind of rental companies, anything that is below class 5, I believe. Now, moving on, what that means for the company. So there are larger customers that are able to be cross-sold within the same industry. So let's say we get a large customer that decides to try a forklift fleet. So they get a forklift fleet, they decide that they like how it's being tracked and they want to expose that into their logistics sector. So now whatever is being transported can also be exposed to PowerFleet and they're able to cross-sell those large customers. That helps them build their relationship and it helps them also keep all of that revenue from different segments within the tracking industry inside of their company. Now, Tyler, did you want to take it off from here for me?
Yeah, absolutely. So talking more about PowerFleet and their SaaS platforms. So these platforms are going to be fully integrable with the already existing ERP systems that companies may have. So making the transition into a PowerFleet software a very smooth one. Also, as Anton mentioned before, all of the assets are going to be seen in one central location versus having them spread out across a wide variety of different places, which is going to make it a lot easier to analyze and make smarter, more intelligent business decisions. And finally, with machine learning, obviously this has been a hot topic of discussion within businesses for the past couple of years now. And moving forward, we're going to show you a few numbers proving the point of how machine learning and companies investing into machine learning has been growing. But just tying it in, companies utilizing softwares like PowerFleets to be able to take advantage of this machine learning and ultimately making smarter business decisions. So moving on here, if we take a look at PowerFleet's revenue structure, they're going to be about 60% of their revenue is going to be locked in through long-term contracts. So these contracts are going to run about 4 years on average, or 48 months. And with these contracts, the gross margin is going to be about 64%. Now that's going back to the fourth quarter of 2019. But just ultimately, the biggest takeaway from this slide is that 60% of their revenue locked into those long-term contracts. We've seen this theme before with some of the past companies that we bought, like ATSG and not the last two pitches. So kind of keeping that trend with this locked-in revenue. So moving on here, If we take a look at, obviously, 2020 was a tough year for a lot of companies and a lot of the clients of Powerfleet, but what didn't necessarily have a direct material impact on the number of subscriptions. So if we look back in the second quarter of 2020, back in the heat of the pandemic, a lot of companies were looking to potentially cut costs and look to save on certain areas. But going back to that theme of machine learning and these companies recognizing the importance of investing into this type of technology, it wasn't the case. Powerfleet was able to add 40,000 subscribers by the end of 2020, which again ties back into that whole theme that these companies are realizing the importance of investing into this new technology. So with that being said, I'll pass it off to Tim, who's going to talk a little bit more about some of the growth opportunities.
Yeah, absolutely. Thanks, Tyler. So for those of you that were on the last call with us, where we talked about ATSG and their exposure to the e-commerce market and how the pandemic has really caused structural changes into that and made that grow a lot faster. The same is kind of true here with Powerfleet. As supply chains get more and more complex, as freight grows and demand for logistical services grow, you're going to see increasing demand for asset tracking. On this slide here, we have the value of the asset tracking market set to hit $55 billion by the end of 2026. That's a 17% CAGR, and that's even 3 times that of the broader logistics market. So obviously a lot of tailwinds for the top line, but even more attractively for Powerfleet as we move on to the next slide here, we can grow the top line pretty fast just from all that industry tailwinds, but your EBITDA and your cost structure is even more attractive in this case. Even in the past, if you look at EBITDA, it's narrowed considerably. While we have good revenue growth, EBITDA has grown at 285%, more than 160%, and all the way up to 624 in 2020 with some distortions from the acquisition. But just underscoring that to sell their products, you don't need incremental increases to OpEx lines to grow the revenue. So that should, as you can see in our model, we have pretty flat or slow growing growth to the OpEx lines, which should translate to higher EBITDA margins and higher free cash flow in the future. It's important to note management's targeting 25% adjusted EBITDA when they hit $20 million in revenue. We see that as pretty aggressive, but we still think there's value in here, as our model showing that even as the EBITDA grows up, to the upper mid-teens, there's plenty of value here. So that wraps up our investment thesis. Moving on here to how we conducted the valuation. Very simple, just EV to EBITDA and the DCF. The 2.5 or the 21.5 times multiple for EV to EBITDA is from the WorkCom acquisition earlier this month, which is probably the best industry comp that we're going to get. And then we put a 2.5% long-term growth rate on the DCF. That gets us to $12 at the end of 2022. And then we also have $14 and $8 per share for the upside and the downside case. Upside case, you're just getting more revenue, subscribers per year, a little bit higher ARPU, and then vice versa for the downside case. So with that, I'll pass it on to Sky and she can finish up with the risk.
Perfect. Awesome. Thank you, Tim. So now I'd like to go ahead and move on and touch on some risks to our investment thesis. So first and foremost, we do have the risk of supply chain issues and shortage of semiconductors. However, this hasn't been an issue for them in the past, and in order to prevent it in the future, they are increasing their inventory reserves. So moving on, there is the potential risk of further dilution of equity, since in the past they had to raise their equity. However, their revenues are scaling and their cash flows just hit record highs as they have over 50 million in equity. So this shouldn't be a problem for them, and they should be able to run all their operations internally. So moving on, there is the potential risk of increased competitive pressure or a weaker demand environment. However, they are a 25-year market player and the market has been fragmented right now. So this shouldn't be an issue, as well as the fact that even in a weaker demand environment in 2020, they were still able to gain new subscribers and generate cash flows. So lastly, there are certain unforeseeable geopolitical events that can occur, but we do remain confident that Powerfleet is well placed to be able to navigate through any uncertainty. So with that, I'd like to wrap up our final pitch and open up the floor for any questions about PWFL.
Looking at the financials, unless I'm looking at the wrong company, it seems like these guys haven't made a profit in years. But you didn't talk about that at all as a risk factor. So talk to me about why we should invest in a company that doesn't make a profit.
Yeah, so they haven't in the past just because they've been small, and it hasn't been to the point where revenue has been outpacing the operating expense line. But as you can see from the margins, when we going back to that slide where we had the growth in EBITDA, we just need a little bit. We don't need huge. I mean, we don't need gigantic revenue growth to really drive the growth of the EBITDA line. And then I think 2020 was really encouraging just because we hit record EBITDA margins and then also free cash flow generation. So I just think going back to the revenue growth and then pairing that with limited growth in the operating expense line items, as we have the tractions and the tailwinds from the growing industry for asset tracking and IoT solutions, as that grows revenue, we should in the future have a profitable bottom line.
So what you're saying is that you think they can just grow the business enough to cover their costs without the costs going up at the same time? Right?
Yeah, because you don't when we come, say, for example, you're a customer of PowerFleet. We come in and we sell you a hardware solution and follow that with a software solution. We don't need huge incremental increases to SG&A to do that, right? You just sell them that, and then your only costs are for the platform and then for the telematic unit itself. But after that, eventually when you hit a point, you're doing that so much that your earnings growth is going to outpace your revenue growth.
Expanding on that a little bit, Tim, the thesis sounds right, but and I guess it's because of the acquisition that they did in 2019, but
Sure.
SG&A showed a huge jump. And is that going to be consolidated at some point and absorbed to get you what you want in the future? Or do we continue to see the margin compression from the SG&A line?
Yeah, so obviously, the SG&A line item's going to go up after the acquisition just because, there's more employees, bigger company. But actually, in the past 4 quarters, I think, can you pull up the quarterly income statement, please? They've already implemented the cost cutting because in fourth quarter of 2019, the SG&A line has already come down by a good deal in the fourth quarter in 2020. So we've already seen some of the effects of that cost cutting and the integration efforts there. So that's kind of the thesis on why we're not saying huge increases in SG&A going forward. Obviously, there's going to be small ones incrementally as the business continues to scale, but I don't think anything that's going to weigh on things.
You sort of also mentioned, I think, in the report, guys, that you would see more acquisitions in the future. A, how do they pay for it? And B, does that continue to be depressing earnings for the next couple of years?
Sure. So they did the equity deal in February. So right now between the revolver, they have a little bit above 50 million in liquidity. My guess is that's to hold it for an acquisition, just because from the investor conferences that I've watched with them, they've said M&A is, it's a strategy for them just because scale is important. So you have to imagine that they're going to use that probably for when a target shows up. Obviously, if it's the right one, if it adds the right capabilities, and if it's at the right price. And then also, even on top of that, not just with the liquidity, but the debt balance is so minuscule at this point, and rates are so low. we still have a ton of flexibility between that and the balance sheet to pursue M&A in the future.
Thanks.
So when you're saying that you think that they're going to grow profit faster than revenue, you're saying that they have operating leverage. Did you actually calculate the operating leverage?
No, I don't think we did. We just did the growth in EBITDA and the EBITDA margin.
Because I mean, what you're saying makes sense if in fact they're kind of at the break-even point. If you have a lot of fixed costs and you get close to break even, then you have high operating leverage and the phenomenon you expressed occurs. But if you're not close to break even, you don't have high operating leverage, and then your costs kind of go up together with your revenue and you don't get free of it. I was also looking at the free cash flow. That hasn't been too good either in past years, although it's good right now.
Yeah.
But, it could be they're at the point you think, but we really need to do these calculations.
I have a question. Can you talk a little bit about the addition of Pointer and what that means just geographically, and expand on that a little bit as far as how they see the trend continuing, looking at, you're showing Israel accounting for 34% of the business now. Do you see that trend continuing? Do you see it exceeding or surpassing the U.S.?
No, I don't see it surpassing the U.S., but what they've been saying is, I mean, Pointer's legacy business is really the connected cars in Israel. So the insurance companies require SVRs for rental cars, and that's what most of the business has been in the past. But they've said there's been huge traction in Israel just because of the peace talks that they had with the peace talks that they've had recently, the peace deal that they subscribed, and that half of the country is already vaccinated, and that they're moving they're doing a lot of more IoT solutions like they are in the US. So they're moving away just from the connected car business in Israel and moving it more to kind of like the legacy solutions that they have in the US for logistics and industrial in Israel.
And Pointer's cash flow numbers, were those in there? Did I see those separated out?
They didn't break it out.
I didn't. So no guess on what those look like. It seems to me like that's maybe a potential source, like Alan was referring to, as far as profitability. It looks like it's pointing to them kind of being able to uphold that for them.
Yeah, I mean, I wouldn't say it's all derived just from Pointer. I'd say part of it goes back into just the operating leverage. Again, when you get past that inflection point, when you add it, you're going to be able to, eventually turn positive EBITDA and cash flow. But I don't know regarding the Pointer cash flow. They didn't break that out.
All right, I think that may be all of our questions for you guys. For some reason, I can't speak. There's big echo.
It might be us.
It's possible.
All right, I'll put us on mute. All right. Thank you, everybody.
Thank you.
Thank you.
I'll try again. Okay, maybe me here. I think this is better. Yeah, sorry about that. Okay, we'll move on to Immersion, the next group. And as you have probably noticed, our final pitch has a small cap theme, as we believe the most ignored groups may have the most undervaluation or mispricing opportunities for us to explore. So without further ado, I want to give away the secret sauce. I will let group 2 take over. Go ahead, group 2. If you're ready, you can go ahead. I think they might be muted.
Yeah, I think so, Leo. I think they're not able to hear you.
Oh, hey, Dr. Chen, we're working on the presentation.
Go ahead. I think you were muted.
Yeah. Should get it right?
Raphael, if you can hear me, you can get started.
Hey, Dr. Chen, we're actually working on trying to get the presentation up. We're having just technical difficulties real quick.
Okay, no problem. All right, good. I think we can get started.
Can you guys hear me now? Let me see. Good afternoon, everybody. Thank you for joining us today for our final pitch of the year. My name is Robert Cameo. I'm accompanied by my colleagues Arvind Thoda, Rafael Nobre, and Mark Zavalos. Today, we're going to be going over Immersion Corporation. They're a small tech firm that's focusing on haptics. And we're going to be discussing the reasons for the investment today and then the different growth opportunities that we see in the future. Moving on to the next slide. Immersion currently has a market cap of $276 million, and they're part of the software application and industry in the technology sector. They're currently trading at about $8.47, and we have put a target price at about $12.45 with an implied return of 47% here. And then if you can see here on the left-hand side, we have their stock performance. As you can see, in early 2021, late 2020, the stock performed really well, and this was largely due to inflated PS5 expectations that was really driven up by a lot of momentum investors. Once we saw the hype started dying down, the price started to drop a little bit more. And we also saw the price drop because of PS5 sales slowing down due to the different chip shortages that we have internationally. Another reason too was also that Immersion entered into an equity distribution agreement that aided into the dilution of the stock price. However, the current stock price reflects the same, the pre-PS5 launch price. So we believe now would be an opportune time to get into the investment to still take advantage of those different PS5 growth and revenues that we're going to see. So moving on now with our investment thesis, there's 4 main points to our investment thesis that I want to touch on. The first one is that Immersion is a market leader in a niche, fast-growing industry that's revolutionizing the way that people interact with their tech devices. Additionally, with their relationships and over 1,900 different patents that they have, they're well positioned to take advantage of this growth in this haptics industry. The second is that Immersion is likely to benefit from this PS5 launch through their royalty revenue that they're going to receive for the many years to come, as well as their different success that they have with using haptics inside of their PS5 controllers. We're going to see an increase in demand for haptics tech in the gaming industry in the future. For the third, Immersion has a lot of growth potential in the automotive industry, and it's a great opportunity for bottom line growth and higher growth margins as vehicles become more and more technologically advanced. And lastly, Immersion has a strong balance sheet with no debt and ample cash coming from stronger earnings sustainability as revenue shift to a more consistent royalty revenue model. Moving now to the next slide. To quickly go over the company itself and what they actually do. So Immersion Corp is a leading provider in haptic technology, and what that basically means is just it's a broad term describing technology that users experience using their sense of touch. So so Immersion creates, designs, and licenses these kind of technologies, and it really allows people to engage and experience the digital world more naturally. They focus on, their main focus that they focus on are mobile, gaming, and automotive markets. And then this will become increasingly more applicable to different markets in the future. They also have 3 main operating segments that they have. The first is their mobile, wearables, and consumer segment. Next is their gaming devices segment, and lastly is their automotive segment. For their mobile segment, this largely relates to the different haptics used in cell phones and smartphones, and this is a lot of these uses are for mobile gaming or a lot of the touch features that you see on your touch screens. Next, we have gaming devices, and as you probably wondered why I'm wearing my gaming headset and then my gaming controller, it's largely because this company deals a lot with those different haptics that we see in these gaming controllers and things. And lastly, we have their automotive segment. Haptics plays a big part in a lot of the touch essential pieces in car interfaces that you see with climate change or climate control and music, and a lot of the different slide bars and touch bars that you see on your vehicle's car dashboard. So moving on to the next slide we have here, we believe that there's a lot of growth to be had in the haptics industry, and largely because of the importance and the impact that it has on daily lives. The digital world doesn't really provide that meaningful experience or that meaningful touch experience that we see with real life interactions. And through haptics, Immersion allows them to simulate these real world interactions through touch and different vibrations. And so we're going to see a lot of different improvements in the way people view their digital experience, and it's going to make their digital life more vivid and meaningful. Now I can move it on to the next slide with Mark, and he's going to talk a little bit more about the different end markets that they play in.
Thanks, Rob. So the haptics industry is ever-changing, becoming more standardized, and this means that this is an inflection point for IMMR and the haptics industry as a whole. So an example of this would be in the automotive industry. And in the automotive industry for the US, the National Highway Transportation Services Safety Association first introduced haptic design guidelines for vehicles in 2016. And so this was for a safety feature to ensure that drivers use their seatbelts while driving. Another example would be with the Institute of Electronics and Electrical Engineering. They reported a tactile, which is also refers to haptics, internet report in 2019. And this included a lot about 5G technology and how 5G technology will be able to really propel haptics to the future, because 5G technology has low latency, so slow, there's no like lag to the way that devices respond to each other. So this will really expand the use for haptics overall in many industries. So next we'll go over the industries that IMMR mostly targets currently. So the first one being mobile. Currently, mobile is the largest segment for IMMR. They have a lot of reputable associations or clients like with Google and Samsung. For example, like Pixel phones and Samsung Galaxies. And so in general, this market, the global smartphone sales increased about 3% globally. But with the transition to 5G technology, this will really catalyze in the next few years, because think about with COVID-19, there's a lot of lag in sales overall for many different products. And so that includes smartphones too. And so with that and a lot of new 5G smartphones coming out, there will be a huge increase in the cycle of people purchasing new smartphones. And so even Gartner Research proposed that about 11% increase, they expect about 11% increase in smartphone sales just in 2021 alone. So next slide. So also for the gaming and VR area, this is one of the fastest growing areas for the IMMR. And so IMMR is really focusing on creating more recurring revenues for the company. So focusing more on transitioning to the royalty side versus the fixed. Show this well with their client Sony and their PlayStation. Or PlayStation 5 controllers. PlayStation 5 recently came out in November 2020, and this was one of the largest launches in the US. Actually, it was the largest launch of consoles in the US, and is expected to continue to outcompete competitors like the Xbox, for example. And so for Sony itself, they expect that at least a minimum of 64 million Sony PlayStation 5s will be sold through 2024. And so you can expect that more than one controller will be sold per unit of PlayStation 5. So closer to two controllers for each unit. And for this industry, a lot of the growth also comes from virtual reality. So for virtual reality, the growth, or actually the company had two new agreements recently that they talked about in their quarterly earnings. And so this market also is expected to grow at a CAGR of 18% through 2028, and then the gaming market in general is expected to grow at 12.9%. So now I'll pass it over to Rafael.
Thank you, Mark. Automotive segment and developments going into the automotive industry. Haptics technology will have the opportunity not only to enhance drivers' experience, but also safety. While the total global automotive sales is expected to increase at a 3.1% CAGR, the percentage of those vehicles that will have automotive touch panels is expected to increase at a much faster rate. In 2018, about 2/3 of the overall vehicles in the world had automotive touch panels, but by 2023, this number is expected to increase to 90%, which will therefore increase the company's total addressable market for this segment. Currently, the company already has significant clients within the automotive industry, such as Continental, Bosch, and Panasonic Automotive Systems. When it comes to automotive interior design, these companies I just mentioned are within the top 10 by market share. Additionally, the company has just signed a commercial agreement with Faurecia, which is the 9th largest automotive parts manufacturer in the world, and it is estimated that approximately 1 of every 3 cars in the world have some sort of automotive parts produced by Russia. And finally, the company is also expanding internationally. The company just signed a multi-year contract with Wari Industrials, which is an automotive manufacturer from Korea. Next slide, please. Revenue and operating targets. Currently, the company's revenues are mostly comprised by patent licenses, which allows the company to have a high margin revenue foundation. The company intends to keep its current clients through contracts, renovations, and also seek new opportunities within the automotive, mobile, gaming, and also other emerging market opportunities. According to managers' expectations, the revenues are expected to double by 2023, and operating margins are expected to reach levels between 20 to 25%. Furthermore, the company is also switching its revenue model from the pure majority of patent licensing to a per unit royalty revenue. And in the future, it is expected to comprise 80% of the total company revenue base. This will in turn help the revenue with its goal to build a more stable and reliable revenue stream and cash flow generation. Next slide, please. Financial position. The company is currently in and has historically been with a strong financial position and healthy balance sheet. Currently, the company has no debt outstanding, and its liquidity ratios such as cash and current ratio are outstanding at 6.7 and 8.5 in 2020 respectively. This should allow the company to further finance its future M&A activity and also supports its organic growth. Now, speaking about profitability, the company's EBITDA and revenues have been quite volatile over the past years. But as I said before, the company is transitioning its revenue model, and we do see a brighter and more stable future for the company. As seen from the chart, EBITDA has recovered nicely from 2019 to 2020, and with PS5 revenues kicking in, we did forecast that EBITDA will continue to grow. And finally, the company being a micro cap with approximately a 265 million market capitalization currently holds roughly $60 million in cash, which is kind of an interesting cash position to have. Now I'll pass it over to my teammate, Arvind Thoda.
Thank you, Rafael, and I'll go ahead and discuss some of the risk factors that have been identified for Immersion Corporation. But the first one starting off being a short product life cycle. Now, IMR is part of a dynamic industry in which things change and evolve rapidly. The firm needs to adopt a method to constantly create and innovate attractive products and technologies in order to sustain their competitive edge. Additionally, the firm has a risk of competitors developing a disruptive type of technology or going in-house with haptics, and therefore an active program needs to be implemented to maintain and sustain their intellectual property is patented and they're surpassing their competitors. So number two, the next risk would be limited number of customers. A small number of customers account for a great percentage of the total revenue, with Samsung being one of the largest. Now, if the firm fails to renew these contracts with one or some of these major companies, that will negatively affect their financial performance down the road in the future, followed by the risk in royalties. Now, the product development process for automobiles is very lengthy, and sometimes it can take several years for an agreement or IMR to implement their technologies in certain vehicles for that revenue to be recognized in this particular segment. The next risk would be the PS5 sales and chip shortage. Now, the COVID-19 pandemic has affected the world globally and the world supply chain, consequently creating a shortage in chips. Now, this directly affects IMR due to the sales of PS5s. Sony has recently been struggling to produce and sell its flagship console, which would cause a delay in the revenues. However, we believe this delay is temporary due to the situation of the economy, as demand for PS5 is still high. Now, the last risk is a change in management. There have been several changes in management over the past several years, and this could negatively affect the firm if the new management does not implement its previous goals, resulting in an alteration of its core business strategies. Now, moving on to the scenario analysis, all of these risks have been taken into account, and we've conducted a scenario analysis regarding them. So our bear case scenario shows us a 29.65% upside,
with an expected 23.31 in gross margins by 2023, with weaker PS5 sales, weaker haptic penetration in the automotive market, as well as a decrease in market share. With our base case, we have a 39.84% upside, with expected margins reaching 24.53%, and expected or moderate PS5 sales, as well as haptic penetration in the automotive market and stagnant market share. Now, for our bull case, we forecasted a 25.76% gross margins by 2023, with strong PS5 sales, as well as strong haptic penetration in the automotive market and increasing market share, implying a total of 58.64% upside to the target price. Now, moving on to the valuation, all these target prices are taken into consideration as a weighted average with our 3 valuation methods. We conducted a DCF analysis and also took into consideration the PE and EBITDA multiples. So for our DCF, we use a terminal WACC of 8.33% and a terminal growth rate of 3.5%, giving us a total target price of $11.80 with a 32.62% upside. Now for the earning multiple, we took a 35 multiple of our expected diluted EPS of 2023, which was 37 cents, giving us a target price of $12.78 with a 43.59% upside. Now lastly, with our EBITDA multiple, we took a 13 multiple to get a target price of $13.40, giving us a 50.52% upside. Now all 3 of these target prices taken as a weighted average gives us a final target price of $12.45, represented by the line that we see here on the graph. Next slide. Now to summarize, I'd like to stress 3 main points of our investment thesis. Number 1, Immersion is a market leader in haptic technology, which is a niche and fast-growing industry with rapid advancements in a technological perspective that alters the way of life of consumers' interactions with tech devices. Number 2, the firm has multiple end markets to provide a great opportunity for the firm to increase their total market share and presence. The success of PS5 sales and the growth of the gaming industry in general is expected to cause the sales to rise. Additionally, the expectation for automobiles to become more technologically adept presents a platform for the firm to implement their technologies and their products, resulting in higher margins in the future. And number 3, the firm's recent change in the core business strategy by gaining revenue by royalty per unit and a focus on reinvestment into R&D to enhance their haptic technologies should result in a recurring revenue stream, as well as increase overall earnings in the near future. Thank you, ladies and gentlemen. That concludes our presentation, and we now look forward to any questions.
If I can, Carlton here. With any small company, and I really do love the concept of what you guys are bringing to the table. But first you talk about their financial strength, their ability to maintain and sustain growth. But more importantly, for a company like this, you look at the people. You mentioned in the report that they have new management. I know it's a new CEO is interim. The chief financial officer has only been there for a year and a half, I guess. But most importantly, the chief technology officer has been there for 20 years, and he really seems to be the guts of the technology of the company. How do they keep him? What's the ownership structure like in that company? What's to prevent him from leaving and going to a competitor or something else? Since so much of what they do seems to hinge on him, and he has been there for almost 20 years.
Yeah, we didn't really look into their ownership structure that they have there, or the different management and the different changes that we saw there. So we really don't know how they plan to go there, but
the big concern really is if at some point, given his long years of experience there, he gets disenchanted and leaves. I'm not sure what's the backup situation on the technology front. And it doesn't seem to me that the 2 people at the head of the company now, the CFO or the CEO, really do have the technology expertise.
yeah, we really don't know exactly how that would work or that succession plan there. But we can definitely get back to you seeing the different ownership structure and how that succession plan would work if he were to leave, or if there is anybody else in charge there that would be able to take his place.
Thanks. Yeah, please.
You look at the financials on this company, they're very highly leveraged. It's like what, 8 to 1 or something, debt to equity. Did you look at what's going to happen with the growth scenario that you're talking about with their debt? Will they take on more debt? Will they keep this very high leverage? Will they be able to pay down debt? Have you looked at that at all?
The company doesn't have any debt right now. They have a net cash position. Their debt should be 0.
But it's not. Because their debt to equity is like 8-to-1, something like that. No, it's not 8. I'm sorry, it's 5. It's 4.78 is debt to equity. That's a lot of leverage for a technology company, many of whom have no debt. And so it really is something that we need to look at. I like this haptic stuff though. My car won't let me cut anybody off. The steering wheel vibrates. My watch drives me crazy all day. So I like the story, but I think we need to really look at whether they can maintain this growth and service their debt if they have to. And then of course there's the people issue as well. So there's risk here.
I was gonna say, I think we have a mistake in the ratio stat because we know the firm doesn't really have any debt. So I think those debt to equity numbers that you're saying might be an error there. As far as we know, the company really has no debt, and
They have the option to take on debt, but the management said they would rather use the cash positions to conduct their research and continue the business.
Well, unless I'm looking at the wrong company, the return on assets is around 1%, and the return on equity is over 7%. That's a highly leveraged company. Even if you don't know what the debt is, you know it has to be a lot for that much difference between return on assets and return on equity. So am I looking at the wrong company?
I think we can definitely go back and look at the different financials and then try to see where we're getting those numbers from, and then come back to you with a different solution and an answer for you.
Let me look at you. I mean, I was looking at Yahoo Finance. Let me look at your report. Do you talk about debt at all? Do you have any of these ratios?
I believe the right ratio analysis in the report towards the appendix, but we're checking right now to see what we have.
Yeah, the page is turned. I got to get this to rotate here.
Liquidity ratios are fairly high.
Yeah, I think the current ratio is like
8.5.
Yeah, that's kind of the wrong one.
Yeah.
Yeah, I think we're looking at the report here, and we don't have a debt to equity or debt to assets listed.
Okay, well, do you have, yeah, I see that you don't have any, but how about ROA and ROE? Do you have that? Because that would always tell you whether there's a lot of debt. Unfortunately, it's showing up upside down on my computer and I can't make it turn over, so.
Yeah, ROE for 2020 is 8.4 and ROA is 5.62.
But it's very different from what Yahoo says, but it still shows some debt.
Yeah, I think we have a mistake here in the financials, so we can definitely check on that and then look back with Yahoo and Bloomberg.
Yeah, because they say most high-tech companies stay away from debt. They don't like it because their earnings are so volatile, and to have to service debt is a real issue for them. So for these guys to take on this much debt means either they're comfortable that they're going to be able to service it, or it's going to go away. But we really need to know that.
Hey, Alan, I'm in here. I think that's a good point. I believe our students use Bloomberg Terminal. I just checked my Bloomberg. It's obviously not the same number as Yahoo Finance, which I just checked. And also Yahoo Finance does not report the same number as Wall Street Journal, which I'm checking right now. And I know that for sure Bloomberg sometimes gives you modified data. They have their normalized data. So this is an issue we have had in the past, but I'm glad you raised it today. We're gonna have to be careful with it in the future.
Yeah, well, that's why I say, if you're not, if you're not comfortable with the debt number, because sometimes people report it differently. When you look at the difference between return on assets and return on equity, that's usually a flag of, because that's the way you leverage into more ROE is with debt.
Yeah, in the past, to solve this issue, we actually just enforced our raw database being Edgar, straight from SEC. And we'll just go with SEC in the future as well.
Okay.
Yeah, I see on Yahoo Finance the same numbers, the total debt to equity 4.78. So all our financials we got from SEC at Edgar, the 10Ks, like Dr. Chen said, and we've also used Bloomberg, and we built out the model on ourselves, and it's an all equity company.
But even with yours, you're showing total debt of nothing.
Yeah, I'm on this chip. I'm on the SEC website now, and I pulled up their filings. There's no debt. You guys are right. I mean, that's what they've reported to the SEC. I never trust Yahoo, and I rarely trust Bloomberg.
Right, Jim. Yeah, we enforce SEC. We use SEC raw data for our investments.
Yeah. No, but I do have another question.
How are they leveraging the return on equity and return on assets? It has to be from debt.
Well, they do have, they have liabilities, right? So they do have deferred revenue. And it's probably, I bet it's based on deferred revenue, because they do have long-term deferred revenue in their liabilities portion of their balance sheet.
Do you think that's enough to create that difference?
It's 21 million, so it probably skews the ratios so that it looks like debt, but in fact it's deferred revenue.
All right.
We could definitely check and then get back to you with that answer.
Yeah, I have another question though. My question relates to competition. You didn't really talk about other firms that are involved in this industry and where they sit relative to them, and what their kind of relative market share is. I understand it's hard to find because of different industries that they're in. But do you have any comments in terms of other companies that might be in this space and how these guys stack up against them?
Cut off there at the end. Sorry, could you repeat that?
Competition is my question. Who are their competitors? How do they stack up against them? What is their market share? I know that they've got the Samsung business, and PS5 perhaps, but what else is there? Who else is playing in this industry, and how big of a competitive threat are they?
I think the number one competitor would be any in-house production of tactile technology. That would be the number one competitor. But in terms of competitors, we tried looking into it. One of the companies that we found were foreign, so it was in the OTC market, so we couldn't really find much detail on it. And then besides that, most of the companies weren't really focused on haptics, but most they're focused on other industries like pressure for military grade equipment. So we couldn't find too much on comps.
To add on to that, being haptics is a small industry that's growing currently and is expected to kind of take off later on upcoming years as more companies become more tech savvy and technologically adept. So based on our research, there's no direct competitors, but Immersion Corporation is one of the only companies that's out there that has a pure focus on haptic technology and are changing their revenue model to focus on that specifically.
Hey guys, I have a quick question for you. You spoke a little bit about how they're transitioning to a new revenue model. I'm looking at their past year statements. Could you talk a little bit about 2018? You see the revenue triple from 35 million to 110 million, then go right back down to 35 million for the next 2 consecutive years. Was there anything specific that happened then? And could you talk a little bit more about how that revenue model is changing?
So you're referring to the jump in terms of the revenue of 2018, correct?
Yeah, correct. Yeah, I mean, in 2017, they're at 35 million, then go up to 110 million, they go right back to 35 million. So that's a pretty big jump and drop. So I just want to see if anything particular happened there.
So in 2018, the firm actually had a royalty provision of 5.8 million from their Nintendo contract. So they had a 6-year Nintendo contract and a one-time royalty provision. And that's kind of the information that the management disclosed in terms of why there's such a jump in overall revenue at that time. And rather than having the provision go on in the course of 6 years, the firm was paid up front of that 5.8 million, and caused that rise in that big jump that we see essentially.
All right, I think that's it for you guys. Why don't you move on to your sell recommendation?
All right, so welcome back to our final presentation for Smith for Spring 2021. We'll go over our watch list of both Fleur Systems and Starbucks. So we'll go ahead and start with Fleur. So Fleur was purchased by Smith back in early 2016. Currently, the company makes up about 3% of the portfolio and has an unrealized gains of about 81%. So the reason why we placed this stock in our watch list is because of the recent run-up in stock price due to Teledyne's intent to acquire the company, Fleur. And so Teledyne expects to, or Teledyne and Fleur expect to close out this, close out the agreement by mid-2021 to secure that. And we believe that now may be an opportune time to exit the position due to the recent run-up of over 33% since before the news. So we'll go ahead and go over some more factors that will support this and then go into valuation of the companies.
So our watch list thesis, first of all, decreasing government's defense spending. So approximately 26% of the company's revenues come from government spending, mainly defense. And according to 2022's budget plan for defense spending, the budget for defense spending is actually going to increase, but not as much as expected before. And if we do adjust that value for inflation, the defense budget is technically decreasing. So secondly, some of the major money managers of this country are actually closing their positions in this stock, such as Cathie Wood. ARK Investment closed the position when the stock reached some of the price highs after the announcement of the merger with Teledyne. So that could suggest that some of the money managers and investors are not as convicted and are not as confident that the stock will be able to beat the market in the short term. analyst sentiment. So now speaking about Teledyne, CFRA recently initiated a coverage for Teledyne with a sell recommendation and a price target of 401 using a 30 times EPS multiple for 2022 estimates. Next, for valuation, the company currently presents high multiples and our DCFs didn't show enough significant upside. And finally, we recommend that we place Fluor on a watch list because the company is currently under the transaction with Teledyne. It's being acquired by that company. So we should be monitoring the current events and future events. And this transaction is expected to be finished by the mid-2021. Next slide. So just some of the risks we foresee for our watch list thesis. Just some simple ones. Revenue ends up growing at a much faster pace than Fluor expects. The second one would be Fluor and Teledyne end up realizing great synergy and they end up integrating faster than expected. And finally, if both companies continue to make innovative products, and currently they're facing competition, so if they come up with innovative products that can outperform the competition, that could be a risk too. So now I'll pass it back to Tobias.
So I also want to mention that the stock price surpassed our initial price target of $53 from our 2016 price target. Currently it's at over 58. And so for our valuation, since Fluor is most likely being purchased at a premium since they're being bought out, we decided to go ahead and model Teledyne. And so with our model of Teledyne, we went with bullish projections, and both our top line and bottom line expectations are higher than the street consensus. And even with a WACC of 7.54%, we lean towards more of a sell recommendation for this company. And so for the company, we decided to go with a DCF valuation with two different exit multiples, or two different exit methods. First one being the terminal growth rate of 2.5%, and the other one utilizing an EV/EBITDA exit multiple. And so originally in our report, we had a multiple of 22, but we decided to drop that down to 17.5, being more realistic. And that 17.5 refers to the average 5-year of the EV/EBITDA multiple. And so for the EV/EBITDA exit multiple, for the 5-year value that we project, our implied return is 24.22%. So that's really low given that's a 5-year target. And then for the 5-year expectation using the terminal growth rate, we expect an implied return of negative 33.88%. And so with that, overall, we believe that Fluor and Teledyne are expected to give us subpar returns over the next years, and we'll pass it over to the watch list to Starbucks.
Thanks, Mark. So I'll go ahead and talk about the second stock, which is Starbucks, that we're going to be recommending for our watch list. Next slide. So to begin, Starbucks was initially invested in 2020 of last year in April, when the pandemic was initially starting to spread and rapidly spread across the entire world. The purchase price of the stock was $76.65, and with the current price being $118.34. The firm has successfully reached and surpassed its initial target price of $103.25, giving us a 54.39% total unrealized gains. Now, the firm accounts for a small percentage of our portfolio of 1.86%, and with it currently trading at a high PE multiple of 207.04, we want to recommend to keep it on our watch list. Now, moving forward to our watch list thesis. As I mentioned before, the firm accounts for a small percentage of our total portfolio, and the target price has been reached, so therefore there's a potential possibility for a full exit from a portfolio if the firm does not meet the performance expectation this upcoming year, as full recovery is not still obtained yet. Now, the firm is also undergoing a process of closing and opening new stores globally based on prime business locations in order to adapt and adjust to the lifestyle that's been created as a result of the pandemic. Now, one thing to keep in mind, if there are new variants for the coronavirus, there's a possibility for the firm to be continued stagnant in its overall sales and earnings in general. The firm is also trading at a record high PE multiple with high debt levels, which need to be monitored this upcoming year as it could negatively affect its financial performance in the future. Moving on, just a little bit about the investment performance. The firm initially took a drastic hit due to COVID-19. With store closures, the sales and margins have decreased with an increase in costs. There's a total of 600 corporate closures with a net of 300 opening globally by the end of 2020. Now, majority of the revenues during this time were driven primarily through mobile and drive-through orders. However, management expects the Starbucks business in the United States to fully recover by the end of Q2 of this year. In fact, 40% of the stores are already open with limited seating in Q1. Now, with that being said, the firm's revenue is currently still 5% down with a total of $6.7 billion compared to $7.1 from last year, with an EPS of 53% compared to 74 cents. Now, just to hit a little on the catalyst of pre-investments versus current, much of the catalysts have not changed. The Starbucks brand remains strong with its core demographic profile strength being college-educated students with an average income of around $80,000 to $90,000. One thing to mention is the firm currently has an increase in demand for online orders due to the adaptation of the lifestyle as a result of the pandemic. And the firm is actually focusing on this by expanding their digital reach capabilities. And the global expansion has been stable and is recovering slowly. So the journey for the company right now is not quite linear yet. However, there's a steady and slow recovery. I'll go to hand it over to my colleague Rob to discuss some risks and valuation.
Thank you, Arvin. Now I can discuss a little bit of some of the risks that we identified in Starbucks. Comparing the old risks from our previous investment thesis, not much has really changed. We do still see execution risks in their new store growth internationally and within the US. They still also have the potential risk for supply chain disruptions during the pandemic with any future shutdowns or outbreaks internationally. And they're also still experiencing increased labor costs and higher operating expenses that we saw during 2020. But the really two main risks that we want to base our thesis on and we want to emphasize is their high debt levels and the all-time high multiples that they're trading at. Taking a look at the graph here on the left-hand side, we could see that Starbucks in the last 2 years has had an interest coverage ratio, seen a really drastic decrease with further decreases in 2020. The current interest coverage ratio is about 2.7 versus a year ago where it was at around 14.1. Another thing to note here is also that their total debt to EBITDA is about 14 right now, whereas a year ago it was around 2.4. And we see this as a concern as if the business keeps dropping in these ratios and solvency becomes more of an issue and they're not able to pay a lot of these debt obligations, then it poses a huge risk to the firm. However, we're still seeing really low earnings and waiting for that reopening and growth in earnings to maybe return back to their normal levels. Moving on now to some of the multiples that we were looking at. Starbucks is currently trading at a 207 times earnings PE and an EV/EBITDA multiple of about 98.37. Comparing that to the historical averages, as you can see, they're drastically different. And this is largely because of the decrease in earnings that we saw in 2020 because of the pandemic. However, due to this trough despite this trough in earnings, we could still look at their forward multiple to come up with their valuation. And they're currently trading at about almost a 40 times forward earnings, which is historically higher than it's ever been in the last 5 years. And even if we extended out 1 year, accounting for the different increase in earnings and recovery, they're still trading at a 32 times earnings, which is above the historical average of around 28. So we believe Starbucks right now is a little bit expensive, but however, if there are upward revisions in earnings on the back of better than expected reopening sales or better than expected coffee consumption among Americans or internationally, then we could see these valuations making more sense with these upward revisions. Moving on now to some of their comparables, and we can use these to really look at the different valuation. As you can see, Starbucks is trading above most of their competitors across most of the metrics, with the only close competitor being Chipotle, and they've historically been trading at really high multiples. So that's another interesting to look at. Moving on now to a summary of our thesis. We believe that we should really add Starbucks to our watch list to closely watch earnings during the reopening and to see their performance, as well as to monitor their management of their debt levels in the coming quarters. Thank you. That concludes our presentation for today, and we now open up the floor for any of your questions.
Just a quick comment on FLIR. I think you guys gave a compelling argument as to why there was not a lot of arbitrage left in that, given where the stock is traded now and what the offer price was. Teradyne is a completely different animal. This is just a part of it. And even though you guys did a rough cut at it, I don't think we have enough information to make that one of our holdings. So I guess my thought would be, why don't we just take our profits and move on from FLR?
Right, yeah, we definitely agree.
Yeah, that is something that we were considering, but we were just still wondering the prospects of Teledyne, and we didn't really look too much into that. And yeah, the prospects of owning Teledyne. So
the main part that we were concerned is like projecting the financial statements combined. So like the reason why, so we kind of just like looked at both companies on for FLIR, we kind of just thought that if they're being bought out, they're most likely being bought out at a premium. Shareholders are happy about that. So then we referred our valuation to Teledyne, and Teledyne on its own isn't compelling enough to stay with Teledyne. So we assume that there's not much potential with FLIR here. And then even Kathy Wood, she has a run rate expectation of 15% annually. So she doesn't expect that with FLIR. So maybe we should do the same.
Yeah. No argument on that, folks.
Both of these stocks have really high multiples. Even the forward multiples are extremely high. So certainly those should be red flags. I'd be okay with getting rid of FLIR now too for the same reasons. But I think Starbucks is a lifestyle story. It's not just a financial story. And we really don't know what they're going to look like coming out of the pandemic. I know they're switching a lot of stores to just drive-through only, which makes it really difficult for me on my bicycle. But I like putting them on the watch list. I wouldn't get rid of it yet. Let's see what they do. But getting rid of FLIR would be okay.
yeah, that was the main reason for our watch list for Starbucks. We know it, yeah, like you said, it is a lifestyle play, and we tried to sell it previously, and then I think the stock went up again like 20%. So I think we learned a lesson there, and we were just looking into the different growth that they have, the strong brand that they have, a lot of the different things that are coming out of the pandemic that they're going to benefit from. That's why we kept it as a watch list. The only thing we had concerns with were the debt levels and then the multiples, wondering if maybe we've reached the top or different things like that. So that's why we decided to keep it on the watch list, just to keep an eye on it.
Yeah, that's fine if we really watch it. I mean, if it's on the watch list, we got to watch it. But you know, Starbucks has fooled us before, where it seemed like it was overvalued and then it went up again.
Yeah, I agree with Alan completely. And part of the thesis when we bought it was that when the pandemic hit, and you go back to what happened historically, the recession of 2008, 2009, it came out like a rocket, and it did the same thing again this time. So I'm not that concerned, you know, if there is a little weakness as a result of a second occurrence of the pandemic. I'm a little concerned that, you know, the valuation levels are getting high, but I agree with Alan. It's one I just monitor closely to make sure that they're continuing to be able to do the things that, you know, they have projected that they will do.
I would agree. I feel like Starbucks is like the cat with 9 lives. I feel like they always come out of nowhere. I will say personally that McDonald's has been showing that this model is actually working better for them in some cases. And so it wouldn't surprise me if Starbucks came in and said the same thing when the numbers come out. So I agree, if we're going to watch it, we should really watch it because it may actually have an upside, more upside to it.
Yeah, I mentioned when we bought the stock that I wrote a case study on Starbucks for my class at Cal several years ago, and I sent it to Howard Schultz, and he had one of his VPs call me and discuss it. So they really do watch what's going on. I was very impressed with the whole event.
And Alan will watch it too. If we keep it on the watch list, we could sell it tomorrow. We'll keep close an eye on this stock. But the idea of a sell recommendation or watch list is really to keep our portfolio management to the fullest, if we want to really perform well. And the students, I think this year have done a great job launching our sell recommendation, integrating this into our pitches. And with that being said, that concludes our last pitch for this cohort. Yeah, cohort 2021, congratulations. You've done a tremendous job this year. We're very proud of you. This is really, I would say, one out of many, many years kind of experience. So I'm sure when we look back next year in 10 years, we'll have a good laugh. And but anyway, this has been an extraordinary year. You've done great. Congratulations. And everyone, thank you so much for joining us today. And thank you so much for your support this year. Remotely, but I know that we will see each other soon. So that makes me really happy. And in the meantime, if any questions or suggestions, please don't hesitate and let me know. Our students, good update is that most of our students have gotten good job or intern offers through the pandemic. And I believe our economy is reopening in the world of finance, at least. The job market is looking better, certainly better than last year this time. The last cohort has some really cloudy moments. But yeah, everything's looking better. I look forward to seeing you in the October pitch. And thank you again. Please stay well.
Yes. Everyone, thank you so much for the year. Thank you.
Thank you. Good job.
Bye.
Good luck, guys.
Thank you.